When financial markets stumble, investors often look to central banks or political leaders for a lifeline. One concept that has gained traction over the years is the so-called presidential put. It's modeled on the idea of the Greenspan put, where the former Federal Reserve Chair, Alan Greenspan, was known for cutting interest rates during periods of market turmoil, effectively providing a floor beneath asset prices. The presidential put, then, is the expectation that a sitting U.S. president will take policy actions, whether through fiscal stimulus, tax cuts, or diplomatic reassurances, to stabilize financial markets during crises. Presidents Obama and even George W. Bush were perceived rightly or wrongly as having a hand on the tiller, ready to soothe Wall Street nerves when needed. But under President Donald Trump, this dynamic appears to have shifted. Rather than playing the role of market stabilizer, President Trump has embraced a more confrontational and transactional style of economic policy. His administration has prioritized domestic industrial revival, reshoring supply chains, and rebalancing trade, often through tariffs and economic nationalism. For example, in April 2025, President Trump announced sweeping 10% tariffs on all U.S. imports, with even steeper tariffs up to 34% on goods coming from China. Markets didn't take kindly to the move. The S&P 500 dropped over 4% in a single session, and the Dow lost more than 1,500 points. Retail investors panicked, and the broader sentiment shifted from bullish to deeply uncertain. And yet there was no pivot, no speech to calm markets. No policy reversal, no put. This leads to a deeper insight. Donald Trump may not believe in the need for a presidential put. In fact, he may see short-term market pain as a necessary price for long-term strategic gains, whether in trade, industrial policy, or geopolitical leverage. In his view, Wall Street may just have to endure some volatility to see America win again. This approach marks a break from decades of precedent where markets operated under the assumption that government would step in to soften sharp losses. Under Trump, there is no clear safety net. The Fed may still play its role, but the White House has stepped back from trying to reassure investors. In this environment, the era of the presidential put may be over, or at least temporarily suspended. And for market participants, that means recalibrating expectations, because when volatility strikes under Trump, the cavalry may not be coming.